Right now, widespread market panic is ruthlessly liquidating a generational tech leader in real time, erasing massive shareholder value. This line chart shows Shopify's valuation collapsing 40% from its peak in late 2025, falling from $179 toward the $108 zone. Investors are selling based on two primary signals: shrinking gross margins and a sharp spike in research and development costs. Within the investor community, these rising infrastructure costs are being read as a sign that management has abandoned its recent commitment to expense discipline. This valuation treats Shopify as a legacy software vendor, overlooking the rapid expansion of its financial transaction engine. CEO Toby Lutke is projecting calm stability while the market reacts to the quarterly numbers. This disconnect hides the fact that Shopify has successfully moved beyond its origin story to become the premier financial infrastructure of the internet. To understand the margin pressure, we have to look at the structural shift in how the company actually makes money. The original subscription software business still generates $750 million a quarter at roughly 80% margins. This chart compares SaaS revenue to merchant solutions, hitting $2.42 billion in Q1. Because it involves payment processing, it carries a lower gross margin. This compression is simply the transaction business growing faster. The percentage drops, but total profit dollars scale massively. Capturing a slice of total transaction volume provides the business with an uncapped growth vector that software fees alone cannot match. The first quarter results from 2026 demonstrate the sheer scale of this merchant engine. This visual represents the quarterly gross merchandise volume, which cleared $100 billion for the first time in the company's history. Shopify payments penetration has reached 67%, meaning more than $67 billion of that volume flowed directly through the company's proprietary rails. Management, led by President Harley Finkelstein, is focused on deepening this penetration across every geographic market. By capturing uncapped upside from merchant volume, Shopify established itself as a permanent toll bridge for global commerce. This brings us to the capital investment that initially scared the market: the spend on AI infrastructure. Shopify co-developed the Universal Commerce Protocol to solve a specific problem, standardizing chaotic product descriptions into a rigid framework designed for machine readability. The company has already used this architecture to structure over 1 billion products in its catalog. This allows AI agents, like those built by OpenAI or Google, to find products and execute purchases autonomously for their users. Because this protocol syndicates directly to ChatGPT and Google, external AI agents must utilize Shopify's standardized checkout and payment rails to complete a sale. This investment is a calculated effort to become the mandatory data layer that all future AI commerce must pass through. This cash flow statement details the underlying financial health: a 15% free cash flow margin, and $481 million in cash generated from operations in just 3 months. This cash generation supports the $5 billion share repurchase program authorized by the board. This chart highlights the current valuation disconnect. The stock trades at roughly 9x forward revenue, well below its 10-year 15x median. Analysts identify 3 accumulation zones: start a position between $100 and $105, add more between $94 and $96, and buy aggressively under $90. This thesis assumes a long-term investment horizon of 3 to 5 years. The recent margin volatility is temporary noise, masking a powerful, compounding growth engine that continues to expand beneath the surface. Shopify is a high-conviction asset to accumulate on weakness, having successfully built the definitive transaction layer for the AI era.